Every time you swipe a credit card, pay a bill, or even skip a payment, you're leaving a footprint. Most of us never think about it. Until the day we walk into a bank and ask for a loan. In that moment, the lender isn't looking at your outfit or listening to your rehearsed speech. They're turning on a financial X-ray to look at the skeleton of your past 10 years. Think of it like an interrogation where you aren't allowed to speak. The bank pulls up a file that knows exactly how you handled that car repair 3 years ago, and whether you prioritized your Netflix subscription over your credit card bill last month. They see the version of you that exists in cold, hard data, a version that might be very different from the person sitting in the chair. But here's the thing, that X-ray isn't random. It's a very specific, very predictable formula. While it feels like the bank holds all the power, the truth is that they are following a script. They call it the 5 C's. And it's the secret code that determines who gets the keys to a new home and who gets a polite, better luck next time. Just if you've ever felt like the loan process is a black box designed to keep you out, you're not alone. But once you understand the math behind the mystery, the power shifts back to you. Today, we're going to look through the eyes of the lender. We're going to show you exactly what they see on that X-ray and how you can fix the broken bones in your credit before they ever hit print. The first thing the bank looks for is something they call character. Now don't be fooled. They aren't checking to see if you're kind to your neighbors or if you volunteer on weekends. In the world of lending, character is simply a code word for your reputation as a borrower. Think of it as your financial shadow. They look at your credit report to see if you're a man of your word in the eyes of the law. Have you ever walked away from a debt? Do you pay your bills on the day they're due, or only when the late notices start turning red? To a bank, your past isn't just history, it's a crystal ball. If you've been reckless before, they assume you'll be reckless again. But let's say your character is spotless, your credit score is high, and your financial shadow looks perfect. That leads us to the second hurdle, capacity. This is where the emotion leaves the room and the cold hard math takes over. Capacity is the bank's way of asking, even if you want to pay us back, do you actually have the breathing room to do it? To find out, they perform a surgical strike on your bank account. They calculate your debt-to-income ratio, or DTI. Imagine your monthly income is a pie. The bank looks at how many people are already eating from that pie before they even arrive. If your car loan, your student debt, and your credit cards are already eating 40% of the pie, the bank knows there isn't enough left for them. They aren't just looking at what you earn. They're looking at what you keep. Because at the end of the day, a high salary doesn't matter if your expenses are even higher. So your credit is clean and your income looks solid. You're halfway there, but banks are professionally pessimistic. They don't just plan for your success, they obsessively plan for your failure. This is where they look for their safety nets, and they call them capital and collateral. First, let's talk about capital. In the banking world, this is known as having skin in the game. The lender wants to know, if this entire plan goes south, are you going to lose sleep or just walk away? If you're asking for a $200,000 loan but you only have $50 in your savings account, the bank sees a massive red flag. They want to see that you've invested your own sweat and tears into your financial life. They look at your down payment and your cash reserves. To a bank, a borrower with skin in the game is a borrower who will fight to keep their head above water when things get tough. But even then, the bank wants a plan B. That's where collateral comes in. Think of collateral as a hostage for your loan. If you're buying a house, the house is the hostage. If you're buying a car, the car is the hostage. The bank is essentially saying, we trust you, but just in case we're wrong, we're going to hold on to the keys to your front door. This is the ultimate insurance policy. They calculate exactly what your assets are worth on the open market today, and what they'll be worth if they have to sell them in a hurry tomorrow. If the value of the hostage isn't high enough to cover the debt, the deal is dead. The bank never wants to be left holding an empty bag. They want to make sure that no matter what happens to you, they still get paid. Finally, there is the fifth and most unpredictable factor, conditions. Sometimes you can do everything right. Your credit is perfect, your debt is low, and your collateral is solid, but the bank still says no. Why? Because they're looking at the world outside. They're looking at rising interest rates, a shaky job market, or a local economy that's seen better days. Conditions are the one thing you can't control, but they're the lens through which the bank views everything else. When you put all 5 of these C's together, the mystery of the loan process disappears. You realize that the person behind the desk isn't a judge passing sentence on your worth as a human being. They are a risk manager following a map. They want to say yes, but only if you've proven that you aren't a gamble. So the next time you walk into that office, don't go in hoping for a favor. Go in with a portfolio. Understand your character, calculate your capacity, and know the value of your collateral. When you speak the bank's language, you stop being a beggar and start being a partner. You aren't just asking for a loan, you're offering them a deal they can't afford to turn down. The digital ghost of your past doesn't have to haunt you. It can be the very thing that opens the door to your future. Now that you know the secret formula, the only question left is, are you ready to fix your X-ray and claim those keys?